I don't see it as necessarily a moral good. If we had a country with 300 million people and 300 million companies, they're all one-man shows, that wouldn't be the best outcome. Also, I think it's just a different thing as opposed to a better or worse.
Welcome to the Next Level Income Show, where it's our goal to take your income, your investments, and your life to the next level. I'm your host, Chris Larson. If you haven't yet, get a copy of our book for free at our website, nextlevelincome.com. That's www.nextlevelincome.com. Just click on the book link, and I'll even send you a copy if you put your address in.
On today's show, we have Tad Fallows. Tad is co-founder and managing director at Long Angle, a private community for young, very high net worth investors. Prior to founding Long Angle, Tad was co-founder and CEO of iLab Solutions, a SaaS company providing lab management software to universities and research hospitals. Without taking any venture capital, Tad and his partners grew iLab to 75 employees, serving 35 of the top 50 universities in the world before selling the business to a strategic acquirer. Tad, good to see you again. Welcome to the show.
Thank you, Chris. Really excited to be here.
Yeah, I'm looking forward to this discussion because we're in an interesting place in the economy. There's a lot of questions, and I think myself and the audience are really going to enjoy some of the topics we're going to discuss today. But before we do, I'd love for you to share a little bit more with the audience about your background, your exit from your company here before you got to your current role with Long Angle.
Yeah, thanks so much. Happy to share that. I've been running Long Angle for about 2.5 years now. And the kind of reason that my partners and I started this is I originally, out of college, shortly worked in consulting. But then for a long period of time, I bootstrapped a software company. We did software as a service focused on medical research institutions, which was a great experience. Got to see, every college town in America and a lot of them overseas. And, when you bootstrap something, you go from starting as 3 guys in a garage to, ultimately got to almost 100 people. So you get to wear every hat, whether that's finance or legal or HR or IT, any of those things. Sales was a great learning experience for me. But, the probably relevance for what I'm doing now is that process of bootstrapping a company that we paid ourselves almost nothing from, our mid-20s to our mid-30s. And then on one day in our mid-30s, got essentially deferred compensation for the last 10 years of work. And so, on one day had a real order of magnitude change in our net worth. And that led to a whole new set of questions that, we had not encountered before on the personal finance world, whether that was things around how do you take advantage of your newfound wealth and, provide benefits to your without taking away their ability to succeed on their own terms, without spoiling them, without undermining their drive, or, more practical financial things like trust and estate planning or alternative assets or umbrella insurance. And so those were a bunch of new things. And really the challenge that I had there is that a lot of the advice for those kinds of, you might call it very high net worth questions, was coming from, somebody with a product to sell, whether that was, Goldman Sachs or a life insurance company. And we really wanted to set up a community of peers or friends, really, who were in a similar situation where nobody was trying to sell each other anything, where it was just kind of peer-to-peer advice on this, new set of questions. And so that was what led me, and I have 2 partners, Matt and Suram, to the program we're currently working on, which is a private community for, very high net worth investors, peer-to-peer connections, called Long Angle.
Yeah, well, what I love is, Tad, this was born out of a desire and really a need for information and to figure out, what do you now do with this wealth that you've created? And I think, one of the points you made was, you got this deferred comp after, working for 10 years or so, a decade on your business. And, that is one of the things that, entrepreneurs do, right? They're paid last. And I think a lot of people, they don't want to take that risk. They play it safe. They say, "Oh, okay, I'm gonna just take this job and do that." What led you to want to start that company, if you don't mind sharing that?
I think I'd always had an interest in being an entrepreneur, and actually, in retrospect, as I look at it, my dad was a journalist, but always kind of, doing his own thing as opposed to seeming, he ended up at one company for a long time. Being a journalist is a fairly sort of solo practitioner kind of thing. My brother is actually an entrepreneur. He started a company that was successful that he ultimately sold to Google. My grandfather actually started a manufacturing company. So I think a bit of a family. Yeah, exactly.
Yeah.
And then I would say also, a lot of this retrospect looks like more of a plan than it was at the time, but I think the timing was good where I've been working in consulting for a few years, but I wasn't yet married, didn't yet have kids, didn't yet have a mortgage. So I think being in your mid 20s is not a bad time when you don't have those obligations and you can afford to fail. I think we were lucky that it was successful, but that was as much luck as it was hard work. And I think it easily could have turned out differently. And at certain points, it certainly got close to looking like, hey, maybe this isn't really going to make it. We need to go back to the traditional W-2 job. So the way that I went into it initially was saying, hey, I want to have a great experience here. I want to feel like if this is not successful, if it doesn't make money, still a good experience. I've learned a lot. I've worked with my friends. I've given it a go. And then maybe I can, go back to consulting or some other career. And I would say it felt that way. There was a little bit of a moment there. The first 2 or 3 years, it's like, hey, this is great. It's been a fun learning experience. We're working in a garage, with buddies. Then after you got to sort of years 3 or 4, and it was kind of there in a revenue, but it wasn't really reaching escape velocity. And now, at that point I was married and my wife was saying, hey, what about the salary thing? It touch and go for a while, but fortunately right about that point, we, like a lot of companies had a quote pivot and, started growing our revenue a lot more quickly and hiring people faster and expanding margins. So the economics got good, when they needed to.
Yeah, that's great. And I think, look, entrepreneurs, in my opinion, I'm very optimistic. People talk about, oh, we're running out of, the environment, we're destroying the environment, we're running out of water, all these issues. I think that entrepreneurs are going to solve these issues. I think that that's one thing that America has fostered, is this culture and, probably just like you kind of touched on, there's some genetics, right? Like people that came to this country came seeking a better future, the opportunity, and it's in our blood. It's probably literally in our genes. So I'm very hopeful of all those things. And, you also brought up another good point, which is the statistics don't always show all the failures of all the businesses that are out there. All these businesses that started, they fail. We tend to glorify entrepreneurs, Elon Musk and Bill Gates. And, I always think of Michael Dell and Bezos and those guys, because they were who I studied when I was in business school. But my wife and I both went through the same process, but we kept our jobs when we started our businesses. A lot of people ask, why did you do that? Like, well, it was kind of a safety net, but it gave us this opportunity. When did you decide to leave your job in that process, Ted?
We did try initially to, do it on nights and weekends. But, my partners and I were both in consulting, and it was one of those things where that is a 60-hour week job as it is. It is, nights don't really exist. You kind of take a break for dinner and then go back to work, and then, weekends exist. But I think we ultimately felt like, after 6 months or so of trying that, hey, this really isn't going anywhere. We're just sort of wasting our time. So either we need to commit and take a leap and make it happen. Now, I don't think that is necessarily right in every case. I think there's other cases where if your job is more manageable, or if, you do have greater financial commitments, and so you sort of can't afford to take that approach, I think it really depends on the person. The other thing that I would do if I were looking in retrospect and, doing it differently, one thing I probably would have done was setting up clearer targets up front of saying, okay, after 6 months, we need to be here. Let's say we want to be at stage 10, we need to be at least at stage 5, or else we're going to call it and do something else. And after 12 months, we need to be at stage 10, and maybe we want to be at stage 20. Having some of those thresholds so that, it's be a lonely journey and a difficult journey with a lot of setbacks as an entrepreneur. Maybe you'll get the occasional, Facebook or Instagram or something where it's up from day one, but in practice, for the rest of us, it's not always going to be clear whether you're on the path to success or not. And I think there is, a risk of giving it early, but I think there can also be a risk of staying too long. Your time is really worth something. And, most people with the ambition and drive and ideas to start a company probably could start more than one company, or they could go and be successful as an employee somewhere else. So I think that's what I advise people who are looking at starting one, is to have those thresholds also, so you don't agonize every night about saying, is this working or not? But you sort of know, hey, here's the times we're going to check in on it, and then we'll put heads down until we get to that next checkpoint, and we set some, minimum thresholds. So that's one thing that I would look at.
Yeah, I think that's great, because you have those, and you also say, hey, we're on the right track, right? We're not floundering out there and doing that. James Altucher, I think I'm saying that right, wrote a great book. I think it's called The Rich Employee. And he talks about that, hey, you can be kind of an entrepreneur, right? You can be like inside of a company. I did that in
Yeah.
a lot of ways as a sales rep. I had a lot of flexibility, a lot of freedom. But at the end of the day, I was creating wealth for somebody else, shareholders instead of for myself. Um,
And I would
so
say, by no means is entrepreneurship for everyone. My wife, she is very successful as a, executive at a bank, but she would never want to be an entrepreneur. And so I think I would not encourage anyone does it just for the money. Say, hey, I want to get as rich as Elon Musk. No, you're not going to get as rich as Elon Musk, and your expected value of working that hard is probably going to be higher if you go work for Google than if you be an entrepreneur. I think you should do it because you have that drive or that passion, either this idea or just the idea of I want to work for myself. I want to work with my friends. I think those are the reasons to do it. But I don't see it as necessarily a moral good. If we had a country with, 300 million people and 300 million companies, they're all one-man shows, that wouldn't be the best outcome. Also, I think it's just a different thing as opposed to a better or worse.
yeah, Sam Zell, I just finished reading his book. He passed away here recently. I thought it'd be a good time to read it. And he said, if you look at most billionaires, they didn't get that way because they wanted to make $1 billion. They got that way because they were passionate about an idea. And I think you're right. Like if you're passionate about something, you really want to go after it. That's a great reason to solve that problem as an entrepreneur. But it's in a lot of ways like being a professional athlete. We glorify it, but such a small percentage of athletes become professionals, and even a smaller percentage of those actually become wealthy doing it. And really, for most people, it doesn't make sense to pursue that passion. So I think there's a lot of similarities there. So Tad, you exit your company here, and you said it was about 3 years ago. Is that when it was?
No, it was about 6 years ago.
I'm sorry. Okay.
I took a while at working at the acquirer. And, frankly, just my kids were 1 and 4 at the time. And I think my
Yeah.
wife had been a single parent up until we sold the company. So also some, time to reconnect with the kids. Ended up being extremely fortunate timing. I wouldn't advise anyone with a brand new baby to the company. So it was nice to move to a job with more finite hours. But then it was so we sold it about 6 years ago, and then about 3 years ago, we started working on this project.
Gotcha. So why not? There's so many, wealth advisors out there, people that cater towards, individuals like yourself. Did you explore those options? Like, why not just go with somebody that's already out there, then go ahead and, start your own community or group?
Yeah, I mean, it's a great question. And I think those are kind of different things. First, I would say what we do in this group is not purely or even primarily about asset allocation. That is certainly
Gotcha.
a set of things people talk about as, hey, direct indexing versus ETFs and tax loss harvesting. And, what's the role of alts in my portfolio? And, or is inflation going in interest rates? But it is not exclusively those discussions of asset allocation. I think there's
Gotcha.
a whole suite of things involved with these questions. As I said, on probably the most important question that our members are grappling with is this issue of, hey, my kids are growing up in a very different financial environment than I grew up in. And how do I take advantage of that and give them the best of these opportunities without, depriving them of their ability to succeed? So I think if you look at a lot of entrepreneurs or, other wealth creators, whether they're, successful lawyers or doctors or other things like that, they'll tell you a lot of their reason for success is the grit and drive that they developed, earlier in their life and the challenges that they had to overcome. And so, then the question is, how do you both personally enjoy your money and give those advantage kids without, having some of the downsides of wealth? So I think, that is a big suite of topics. There's also other things that are just maybe, more kind of lifestyle questions of like, hey, we want to take a family trip to Costa Rica and, we can afford to spend a lot of money on it. What do you guys recommend as, a good travel agency to work with or a great place to stay? We'll have some memorable experience, questions like that. And then also, I think a big part of what people are trying to do, in the community and what I wanted was really unbiased advice, where if you, are trying to figure out, let's say you do want to hire a wealth manager, well, which one should I hire? I can go interview 5 of them. They're all going to tell me why they're the best. But if I can talk to 1,000 people in my same situation and said, okay, well, how did you look at a, traditional investment manager versus a family office or a multifamily office or, with, fee only versus AUM based? I think that was a big part of it, is looking for advice from people who are actually personally in that situation and where you didn't have to wonder, what was their advice coming from. I think in the wealth manager world, I don't personally use one, and I would say the majority of our members don't use one. but that is not a, philosophical or moral opposition. I think there are a few cases where it does make a lot of sense. I would say, one is if you're just somebody who doesn't have a lot of interest in, financial topics, or, don't have the time to do it or don't want to develop the expertise, I think there's nothing wrong with, paying someone else to do that. And then there's also, like any profession, there's a whole spectrum from the people who are, truly experts at what they're doing and truly committed to the success of their clients, to the people who are just trying to get AUM and don't really care about the returns they're giving. And, there's everywhere in between. So I think you need to, if you do choose to work with someone, you really want to do your due diligence, because it's if you have a lot of money, then 1% of a lot of money is still a lot of money. And so, it's a very big decision. And, if that person can drive an extra 2% returns for you, make a big difference if you compound that across 10 years. So it's worth doing a lot of research. But even though, as I said, I and most of our members don't work with one, that's, there's nothing wrong with that decision.
Yeah, no, that's a great point. And I love, and this is why you're on the show, Tad. And you talk about very high net worth investors, which is really what Long Angle caters to. Before we jump into the next discussion here, can you define that for our audience?
Sure. I mean, different people will define this different ways, but if you look conventionally at the, private banking industry, they will sort of set three different groups. They'll have what they call high net worth individuals, which are generally about $1 to $5 million of investable assets. Then they will have very high net worth individuals, which I think historically has been seen as about 5 to 30 million of investable assets. And then you have ultra high net worth individuals, which are 30 million plus. So you could quibble with this. You could say with inflation, maybe it should be, 10 to 50 million or something as your definition.
We won't argue that today. We'll go.
Yeah. I would say broadly our membership is in the 5 million to 50 or 100 million. I think when you get up into the 500 million, the billion range, that's typically where you get this called family offices, where someone actually, they don't just manage their things personally and they don't go to some third party. They actually build an entire company or entity that is just managing their vacation houses, their planes, their investments, all these different sorts of things. But I think there is a gap between, or people who tend to find a lot of value in our community in this between, say, 5 and 100 million, where it's just not economically rational to set family office, but you do have a lot of complexity. You are likely to pay estate taxes. You may have, multiple properties, a lot of illiquid assets, maybe a company started you haven't fully exited from, and things like that. So anyway, very high net worth, long story short, is generally seen as 5 to 30, although I define it a little bit more broadly.
Yeah, thank you for doing that. Richard Wilson was on our podcast. He was the second guest on here, and he focused on centimillionaires, 100 million plus. Yeah. And one of the tenets of the Next Level Income show is let's learn from those individuals that are ultra rich, right? Because if you want to get to a million is not what it was, as you said, with inflation 100 years ago. It's just not the same thing. And one of the challenges we have, a lot of the members of our community, Tad, they're first generation coming in to these levels of wealth, and the access that they have they're looking at people that are advising maxing out their 401ks and just traditional 60-40 portfolios. But then when we look at the very high net worth and the ultra wealthy, they don't typically have the same types of allocations. What have you learned through the Long Angle community with respect to how these very high net worth individuals, very high net worth investors operate compared to your traditional employee that's just putting their max into their 401k?
Yeah, that's a great question. And one thing I will say, you mentioned a lot of your community is first generation wealth. Yeah. I would say that is, in terms of who I'm talking about, I will also say the bias of our community is almost entirely for first generation, probably 98% people are the original wealth generator, and also skewing relatively young for this net worth level, very heavily 30 to 49 years old. So when I talk about people are doing, it really is people with that profile of, say, your 40-year-old who has been successful. If I look at
sorry to interrupt, but you already mentioned the family, and that's one of the big drivers is how do we teach our children? How do we do this? We're going to get back to grit that you mentioned, but so let you answer that question. What have you learned?
Today's show is sponsored by Money Insights and their Investment Optimizer strategy. In my book, I share how I use this same strategy starting over a decade ago to invest my money in two places at one time. This strategy has been used by the wealthiest for generations for estate planning, minimizing taxes, preserving wealth, and increasing stability for their investments. Now you can do the same thing. In addition, you can build a plan to build an emergency fund, pay for college, fund a business, plan for retirement, and ultimately optimize your total financial picture. To find out more information, check us out at the banking link at nextlevelincome.com.
Yeah. So one thing we've done, which I find I just did out of personal curiosity, but a lot of our members have found interesting, is we do an annual benchmarking study where we ask all of our members, we set, I don't know, maybe 50 or 60 categories. And we say, okay, how does your personal portfolio break down across all these categories of both assets and then different kinds of debt? And then we, aggregate all that data together and share it in a way, expose anybody's personal data, but just in aggregate, what are people doing? And also looking at where is there a lot of consistency and where is the broad spread of strategies. So if I were to just kind of call out some of the highlights from the study that we did last year in 2022, we haven't yet done the 2023 version. I would say in total of people's portfolios, a little bit over half of it is in company ownership of some sort, whether that is public equities of stocks or private equity or venture capital or something where you have an equity position. A little bit over a quarter of it is in equity in real estate. And the remaining 20% or so is in a combination of cash, bonds, and other alternatives. I'd say the biggest change that we saw from our 2021 to the 22 was a pretty material shift away from public stocks toward a combination of private company ownership and real estate. I think some of that was driven during that period by performance of those asset classes, where the public markets went down. There's sort of a natural balancing, and same with real estate, going up during that phase. And some of it was intentional rebalancing. Yeah. A couple other interesting things. One is in terms of primary residence, we then did a breakdown based on where people's net was. And really, all the way up until about $50 million of net worth, the primary residence really maintains a significant or material portion of the balance. I think when you look at people in maybe the bottom end, that high net worth category of 2 to 5 million, it's about 25% of their net worth. But when you go up to people with 25 to 50 million, their real estate primary residence is still about 13% of their net worth. So people are kind of upgrading to houses, in not surprising, but still interesting.
And maybe multiple properties, right? They may.
Yeah. Well, that was actually their primary residence. We looked at,
that was only, okay, I'm sorry.
Like that. So yeah, your typical person with $40 million has, maybe a $6 or $7 million house there.
And that seems reasonable. Yeah.
Yeah. And then, although one that's probably is more surprising is only 25% of our members do not own a primary residence.
Really?
And then of those who do own them, about a third of those don't have a mortgage at all. So only about half of our members have any sort of mortgage. It's interesting. Well, our members tend, on general, to be quite aggressive in terms of their asset allocation, like holding very little cash and bonds. Together, those are only maybe 15% of their portfolio. But on the flip side, they're also taking very little leverage. I would say about 80% of our membership has debt that's less than 25% of their net worth. So, put differently, if I have $10 million of net worth, that I'm going to have maybe, 12 million of assets and 2 million of, I think, a lot less leverage position. Yeah. And that includes, primary residence mortgage. I think, and this is one of those things, back to this idea of entrepreneurs. I think what you generally see is to take a big bet or a big risk on their company, but then the rest of their life, they don't want to take a lot of leverage to compound that risk. So I think, that those are some of the main things that we're seeing. I will say that, I personally am probably, don't look exactly like these. I end up during, not today, but maybe 3 or 4 years ago, looking at the super low interest rates and saying, hey, it seems quite unlikely that if I can borrow at 3% and the government is, spending and borrowing like crazy, that inflation is not going to be above that 3%. So a good time to sort of load up on debt and buy real estate. I think that turned out to be a lucky hypothesis. So, you do see a spread of things, but, in general, those are some of the key points from that benchmarking survey.
That is really interesting. And I love to look at this because like you made a good point, Tad, it ebbs and flows. It changes a little bit with respect to, is equity markets, real estate markets, and those sorts of things. But it is something that's been common, throughout the 4 or 5 years that we've been doing the podcast, as we bring on individuals that talk about the characteristics of high net worth individuals. Real estate and company ownership, is significantly higher than what you see. It's significantly higher than basically zero, which is your typical, asset allocation if you talk to kind of a traditional financial advisor. But I think that's really interesting what you mentioned on the debt, because again, going back to Sam Zell's book, he talks about the importance of liquidity and really also the importance of not being over leveraged. And I think, as an entrepreneur, you learn, the value of cash flow, right? If you can't pay your employees, if you can't, pay your payroll, that sticks with you. If you go back and, if you can keep your expenses low, then you have a lot more flexibility and really a lot more freedom is what I found in our lives in doing that. And we've kind of taken a hybrid approach. We have income producing properties on our primary residence, which help kind of balance that off. But I'd advocate that for anybody, really.
Yeah. And I think, debt, it really depends on the nature of the debt. I think, part of the reason, for example, that, my wife and I were comfortable a few years ago taking on a lot more leverage is you could get debt that was, not callable. It was a 30-year term and it was fixed rate. So you knew, hey, if I can cover a 2.5 or 3%, then I'm good. It doesn't matter if the nominal value of that property has gone down. The bank can't turn around and tell me that I have to sell it. I think, I would be much more hesitant on something like a portfolio line of credit, where if the stock market goes down 50%, the bank can say you have to sell today and it's, the worst time, or that rate can, the Fed hikes rates again tomorrow and your interest rate is going up right along with. I think, both speaking for myself and our community at large, I think much more comfortable with your fixed rate than your floating rate callable debt. Although I will say on the side, one topic that comes up a fair amount is how much of a cash cushion do you need? Because if you look at somebody saying, hey, I want to keep, 12 months or 24 months of spending, it's actually a pretty big amount of money. And if you just look at historical rates of return, let's say on average, you're going to get 7%. So your money's going to double every 10 years. Well, then over the course of a investing career, let's say that's, 40 or 50 years, that could be 4 or 5 doublings. If you have, I don't know, let's say you've got $200,000 set aside to cover, 2 years spending. If you let that double 5 times, that turns into quite a bit of money. So it's actually, while conservative, thinking about other ways to do it. So one thing that I see a lot of people do is these types of debt that I said, I wouldn't want to take a lot out of, like a portfolio line of credit. You can have that available and just work with a bank and say, hey, look, I've got this portfolio, $5 million here. Let's just agree that if I need to, I can borrow up to 60% of that value. So $3 million. I now don't necessarily need a $3 million cash cushion, because if an emergency comes up or I see some property that I need to buy tomorrow, all cash, I can temporarily draw on that. So I don't have the cash drag, but at the same time, I do have that flexibility. I think that's, something, there's really no harm. You're paying almost nothing or nothing to have that, flexibility available to you.
No, I love that strategy. It's something that we've been doing for a long time. And again, especially if you're an entrepreneur, you want to have access to that capital, because, you may have more variability than somebody that has a fixed salary. I do want to get back to the family component, Tad, because this is something that has become really important to me. I think is a symbol. We live in Asheville, North Carolina. We live right down the road, or right up the road, actually, from the Biltmore. We're just 2 miles away from it. And the Vanderbilts are, infamous for squandering a fortune in a lot of ways. And, I learned that story, and I said, well, how do you, what do we do? What do we do as a family? I love the book Grit. I think it's by Michelle Duckworth, if I recall correctly. And it's something that's interesting, because it's in society these days. I've had a lot of these discussions, where we want to provide or make up for challenges that people are facing out there. We want everything to be comfortable. We don't want, our kids to fall and scrape their leg. We don't want people to go through these challenges, but those challenges early in life, what I believe, compound and create strength and resiliency. And, it's one of the things that I'm hesitant. It's like, well, I want to provide opportunities for our children, but I also want them to develop that grit, as you mentioned. I love that you use that word. And, the resiliency to do that. What are some things that, the long angle community talks about to help foster those traits in the communities, or the community's children, I guess you could say?
Yeah, it's a fantastic question. And I will say, I probably will bring more questions than answers here. I would, if I had this figured out, that would be my full-time job, selling that knowledge. But I can share, maybe some things that have worked for me personally, as well as,
Yeah,
some of what we see our members doing. I
that'd be
think,
great.
first I'll start with one question that's a little bit different than what you asked, but it's a separate one of, you talk to your kids about wealth. If you have been successful and you do have a significant amount of money, at some point, probably early in your expect, the kids are going to come and say, hey, Daddy, are we rich? And how do you answer that question? And I think one thing, I've had a lot of conversations also with professionals who work at these family offices or multifamily offices, asking how they to approach that. And they say the number one thing is honesty, and don't deny it or pretend, because your kids will find out, and you don't want them finding out by Wikipedia and seeing some story about how you're, sold your company. And then that's, because then you're creating this mystique around money, and like, wow, it must be really important and really powerful if it's, this taboo that people won't talk about it, as opposed to just sort of normalizing it.
You can search Zillow. It's like, well, Dad, the house is worth $1 million. It's like, oh, whoops. It's you got the internet out there these days, right? Yeah.
I would say a lot of our members also try and have a open conversation about how money works with their kids. And so, talk with them openly about, well, here's what I do for work. I make these loans, and, well, why would a company want to borrow money at those rates? And this is how it works. And the same way that, you talk with them about the football team, and, talk about the strategies as they get old, you get into more nuance. Hey, here's why the Cowboys did this, or here's why they signed this guy. Or, if you're a camping, aficionado, talking with them about different kinds of tents that you want to get and that thing. I think the same way, if you work in the stock market, or you work in a business, or you have a passion for those kinds of investments, really including those kids in those discussions, like, hey, we are thinking about this rental property, and let's actually just analyze the economics behind it. It's going to cost $500,000, and we think these units will rent for this much, and we have an allowance for the roof and for vacancy and those sorts of things.
I love that.
I think, kids find anything that their parents will actually engage with them on to be interesting. And so kind of building that up, it's not a separate thing that they have to learn for themselves. I think getting back to this question of grit, I will not say that I particularly have seen, anyone with the right answer there. I mean, I can share a couple of things that have worked for me, and I'll give full credit to my wife. I think she's, thought more deeply about these things than I have, but I've tried.
We'll have her on the podcast next then.
Yeah, you should. She prettier and more articulate than I am. But I think, she talks about this sort of gift small failures. And I think that is one of the most challenging things to do. But I would say, my kids are still relatively young. They're 8 and 11. And so just in their activities, recognizing, my son's never going to be a pro tennis player. So letting him fail at tennis, as opposed to, trying to make that successful, that's really one of the things he'll get out of it. So, for example, we've gotten very into Boy Scouts, and, when he goes on the camp out, I say, hey, remember to pack your stuff, but I'm not going to check anything he's packed. And I think, may have forgotten a sleeping bag the first time, but he never forgot a sleeping bag again. So that was a small failure, being like, oh, shoot, he's doing that now, and not when he's in high school and forgetting to write his application essay to college.
Yeah, it's so funny, because my wife's like, did you check the boys' backpack? I'm like, no. She's like, well, what if they forget their lunch? I'm like, well, they'll be hungry, and they probably won't forget it the next time. So and I love that, because it's how can we provide. Your wife said the gift of small failures. Is that the way she described it? Yeah, or like failing forward. That's fantastic. And I talk to my wife. I'm like, how can we provide the opportunity for the boys to fail in a safe environment? Like, we have 2 boys, I say the boys, but the children to fail in a safe environment, because then they can learn from it, right? Where it's not going to be detrimental to the fact that they, lose an arm or something like that from a mistake they made.
Yeah. And I mean, another one that worked for us, I do think every kid is different. Our son is, he's older, so my daughter doesn't have grades. He's pretty academically oriented. And so, he really wants to get into a good college. And we made a point of this past year, or past couple of years, in 5th, 6th grade, the first time he had real report cards with real grades, of saying, hey, we are not going to check if you're doing your homework. We are not going to check what your grades look like. We will give you this first year. You do it yourself. You do it your way. If your grades are great, we're going to keep leaving you alone. If you have problems with the grades, this is going to be unpleasant for everyone involved, and we're going to ride you about it. And he'd rise to the occasion. There was all sort of 96 and 97s, and he had both built a lot of pride it made our lives so much easier because it was not asking about night, have you done homework? It was just, I presume you have, and until proven otherwise. And I think he also built a lot of pride in that of, hey, these are my grades. I earned this. This is not a family project. So again, it would depend on the kid. If he was less academically inclined, we'd need to lean in more there. But I do think, again, in those, nothing they really do at 11 is going to have that much impact other than those character traits that you're building. I think I'd be concerned if we were in a corner now where he's a junior in high school and we're to do this, or, he's at college and failing out there. So I feel like we've done a lot of things wrong as parents, but that's one I feel good about.
It sounds like you're doing okay there. So just to recap that, I think, making conversations about money natural and comfortable, and obviously respond in a responsible manner, as you said, Tad, with your children is important. It's one of the things that we have on our 5 tips for raising money pros with your kids on our website. Looking for those opportunities to expose them to different business discussions, or like you mentioned with the real estate. I took a trip with my son last week to a lacrosse camp, and along the way we stopped at some of our car washes in those locations, and I had a business lunch as well that he came along with, and he sat there and he got to kind of observe it, which drew some additional questions, and to kind of see, hey, these are natural things, and these are questions, and these are kind of the process that we go through as we make these decisions. And on that note, the long angle community helps provide a community so that you can share thought processes, frameworks to better improve not only your investment returns, but like you said, the ability for your family to create generational wealth and to have access to a lot of the knowledge, experience, and expertise that only family offices used to have. Tad, can you share a little bit before we wrap up about the long angle community and how the audience can learn more or potentially even become involved?
Yeah, sure. So the community is still growing now, and I think it has gotten a lot better. We're about 1,700 members. And if you compare it with, say, 170 members, I think it's a richer conversation. A lot of, some of these questions are universal, like raising kids. Other questions can be very esoteric, hey, who knows a good guy for Swedish-Israeli tax treaties? And, you need a very big group of members in order to have, meaningful answer to those questions. So it's something where
I've never answered.
Exactly. More powerful as it grows. So we are excited to keep adding members to it. If people are interested in learning more, they can go to our website, which is just longangle.com. I'd also be happy if any members want to reach out directly. It's just Tad, T-A-D, at longangle.com. Be happy to speak with them. I shared our general member demographics. What we do in terms of reviewing new members is me or one of my 2 partners interviews every potential member. So if somebody applies on the website to become a member, they can, I don't know, look forward to or not a Zoom call with one of us. And we also have as a eligibility threshold, everyone is at least a qual client, which is a sort of SEC definition, but that means you have 2.2 million or above in assets outside of your primary residence. So just in terms of if members want to think it'd be interesting to them, that is one of the qualification thresholds. But we'd be very excited to hear from anybody in your community who thinks that what we are doing be interesting to them.
Fantastic. Well, I wanted to have you on, Tad, because we had a great conversation here just a few weeks ago, and I know a lot of people in our audience, a lot of listeners can draw a lot of value from not only the things you said, but potentially also from the long angle community. So we're going to have all that information you just provided in the show notes. If you want to learn more, you can check out longangle.com or get a hold of Tad directly. Tad, thank you so much for joining us today.
Well, thank you, Chris. Look forward to speaking again soon.
It's been my pleasure.
Hey, Chris here again. I hope you found this episode valuable. Now, I have one more thing to gift you. We have a page for my coaching clients where you can get a free copy of my book, as well as much more from previous guests on the show. Just check out nextlevelincome.com/coaching to get a free copy of my book, audiobook, and much more. I'll send you a copy of my book and cover all the shipping costs as a thank you for listening to the podcast. Also, please like, share, and take just 90 seconds to give us a rating on Apple Podcasts.